Hello, everyone. My name is Mitch and I'm a senior here at Marquette University studying accounting and finance within our Applied Investment Management program. Today I'm presenting on Emergent Biosolutions Inc. under the ticker EBS. I recommend that the AIM small cap portfolio buy Emergent Biosolutions Inc. at a price of $50.38 with the price target of $92.86. Emergent Biosolutions Inc. develops vaccines and antibody treatments for infectious diseases and opioid overdoses, and they also offer devices for biomedical purposes. EBS sells these specialty products to civilian and military populations to address accidental, intentional, and naturally occurring public health threats. Their biggest customer is the U.S. government and armed forces. A little bit about the business. They're headquartered in Gaithersburg, Maryland. They have about 2,200 full-time employees. The firm was founded in 1988 and IPO'd in 2006. Their share price at close on the 26th was $50.38. They have a market cap of about $2,677,000,000. In the last 52 weeks, they've traded anywhere from $49.35 to $127.20. Their price is traded at about 8.8 times earnings in the last 12 months. Their EV to EBITDA has been about 10.62 times. 2020 actual revenues were just over $1.5 million, and they have a double BB ESG rating from MSCI. I recommend that the AIM Equity Fund purchase shares of Emergent Biosolutions at $50.38 with a price target of $92.86, representing a potential 84.32% upside. The thesis driving this is, in addition to their therapeutic offerings, Emergent can drive value with customers through their CMDO business to provide any manufacturing services their clients may need. Emergent has a strong pipeline in the works with diverse revenue streams. They can weather any storms if one of their business units goes down, as evidenced with the CDMO business, which I'll get into. The J&J vaccine snafu has made for an attractive entry point into this stock, as it's trading for a pretty low relative value. The investment drivers behind this pitch: Emergent's contract development and manufacturing CDMO business is a diverse business segment consisting of three different service areas for clients, which include process and analytical development servicing, drug substance manufacturing, and drug product fill, finishing, and packaging. This allows customers to come to Emergent and they can help with any step of the process or be a full-time partner in getting drugs to market. The CDMO business unit has grown at a 55.76% compound annual growth rate over the last 5 years. Management believes that there's a roughly $20 billion total addressable market and expects to see strong mid-teen growth in the space in 2023 and beyond as they weather the storm in 2022 of the J&J snafu and a few lost contracts. Pipeline of potential. It's currently made up of 5 vaccine candidates, 3 therapeutic candidates, and 2 injector device products. Management believes with testing with 3 of these products in the final stage of testing and one of them awaiting approval, that in the next 2 years they'll push 4 new products into the market, and they have forecasted possible revenues of up to $800 million combined for these offerings. Diversified revenue streams. The company's diverse revenue streams will allow them to weather the storm of hard times in any one of their product divisions. And their position in the biomedical defense field, a growing roughly $15 billion industry, will be benefited as wartime methods evolve and the United States increases spending to protect our interests at home and abroad. Think of things like what's happened to U.S. diplomats in Iran and Cuba recently with being and over in Germany with people being poisoned by the Russians. These are things that we need to pay attention to. To reach a valuation for Emergent, I completed a discounted cash flow, which I weighted at 80% with the price target of $81.34, using a weighted average cost of capital of just over 7.25 and a terminal growth rate of 1.25. EV to EBITDA, which was weighted at 10%, generated a price target of $139.43, using a peer multiple of 15.78 times. EBS 2020 was at 5.7 times. Price to earnings was also weighted at 10%, generated a similar price target of $138.41 with using a 2020 peer multiple of 25.28 times. EBS 2020 price to earnings was 9.2 times. Not surprising here that those valuations make this stock look really cheap, as the stock's down well over 50% this year to date alone from the J&J fallout. Some of the risks we might face when investing in Emergent are going to be development mistakes. Any more development mistakes will be disastrous for Emergent. Management needs to ensure that their production controls are strictly enforced to resume investor and business confidence in their ability to produce safe and effective treatments. If they can't do this, they're going to really lose out on a lot of business, and I believe that they may not recover from that. I believe in management's ability with the reopening of the Baltimore plant and the new controls in place, but something to keep an eye on. They're extremely dependent on government contracts, especially here in the U.S. These governments, it's hard to switch, but if they chose to use another vendor, just cut ties with Emergent or cut back, revenues will be severely impacted. And finally, there's stiff competition in this space, in the biotech and pharma space. So management just needs to keep on their toes and make sure they're not losing ground on the competition to produce negative results, revenue, and for the company here. All right, wrapping it up. Emergent will continue to live their shared values every day through the work that they do together. I believe that the low stock entry price will allow investors to buy a slightly beat up quality company at a low valuation at the moment. Their business model is still intact, and its diverse nature will allow for flexibility and stability as they navigate any headwinds. But using the tailwinds that I've identified here today, I think that this is a good time to get into the company. It's been a very good company year over year. They've made a mistake and they're working on owning up to it. So if anyone has any questions, please feel free to contact me. I've put my information down below, and I look forward to seeing you guys at Q&A.